Traders often overcomplicate fundamentals. It can lead to a few things. I'm going to share with you the easy way to go about it in this video. So most retail traders, they think that fundamentals, and they have an image of their head of being glued to the news all day, 30 screens, being some sort of like mathematical genius, going through financial statements and reports all day. And that seems complicated because it is complicated, and it can often make people kind of pull away from wanting to do any fundamental analysis, or they kind of naturally want to believe that it's not all that it's cracked up to be. And it often makes traders generally lean more towards technical analysis because they're like, oh, this is really hard. I want it to be, I want to believe that this is easy. So I'd much prefer just to learn like how to draw on a chart a little bit. This is not me shitting on technical analysis. I'm just saying that is why technical analysis is more popular, obviously. And so in this video, what I'm going to show you is I'm going to show you how you can take hundreds of hours of analysis and condense it in 2 minutes. And this is going to be without me talking about AI at all, because this is not like, oh, use AI and everything gets quicker. Like, it's a lot more. I've thought through it a lot more than just that. And the benefit of this is that knowing this doesn't actually just save you time. It's actually often a better use of time than doing it all yourself, which I will explain as we go through the video. There are exceptions to that statement, but for the most part, for most of you watching, that is going to be true. Now, of course, nothing in this video is financial advice. And so let's get to the name of this magic method that I've come up with. It's called the Information Collection Retention Invention Convention. Yeah, I know it's a great name. I don't need any praise in the comments, but if you want to give me some, whatever. Anyway, so fundamental analysis. What? Let's sort out the what first, then we'll go into the how. Fundamental analysis is a form of edge. What is an edge? An edge is a repeatable method to extract money from the markets. That's it. And how does it do that? What is the machine overall of what's going on? Well, the markets facilitate money moving towards where it's going to make more money and away from where it's going to make less money. That's it. And there are participants within that market that hold the money and move the money. And that's pretty much the whole game. Like, if there were no people moving money around, then whether we thought a stock was going to go up or not wouldn't actually be that relevant, because it wouldn't really need to move much, or it would just be very, very steady. But it's because of how these flows move that enable opportunity. More on that in a minute. And so the big thing when we come into fundamental analysis, because fundamental analysis is all just about prediction. That's the whole game of what fundamental analysts are trying to do. They're trying to predict where that more money is going to come from and where that less money is going to come from, and they want to move the money between those. But the problem is when we come to actually do that, we often get analysis paralysis. Who wouldn't? There are so many factors. If we compare this to analyzing something with a kind of yes or no outcome, like a win-loss outcome. So let's just take horse races here. In order to do that, the first thing that we need to establish is, okay, what is going to influence or make the outcome of a horse race more predictable? So we'd probably start with internal factors. So things like the form of the horse, maybe the characteristics of the horse, like the height or the length of the legs or the age or how it responds to different like types of grass or whatever. And then we have the external factors. So the relative factors, when we're comparing one horse to another, to another, to another, to another, to establish, okay, who's most likely to win? But when you go into that process, anytime you try and predict reality, because reality is not only very complex, but it's also often changing, in other words, it's dynamic, that means that the next logical question anyone is going to ask is, okay, which one of these things matters most? And also, how much does each of those things matter? And this is why fundamentals seem so difficult, because people are trying to consciously or subconsciously figure out, like, why, like what relationships matter, which don't, like how much do they matter, and they're trying to create this perfect model in their head. And number one, that model doesn't exist, or it's very, very complicated, so often it's kind of pointless trying to figure it out. So where does that leave us? Well, it leaves most people confused, understandably, because you're sitting there thinking, well, look, I'm not a genius at making all these models on spreadsheets, and so I can't really do it. And even if you were a genius, if you really thought about it, like, the environments are changing. Like, things are dynamic. There are only a few principles in the market that are sustaining over time. Like, a lot of things are constantly changing and getting like arbitraged out and all that sort of stuff, which we'll go into in another video. And so the players. So we need to understand the players of the game in order to kind of get a bird's eye view here. Because remember what I said, right? The markets are capital flowing from where they think it's going to make more money to where they think it's going to make less money. Sorry, other way around. But these are just a few players. This is by no means comprehensive, but it's important to understand, because if we look at someone like hedge funds, you may think in your head that all hedge funds are like all similar or whatever, and a lot of them will be relatively similar, but they are also all different in a way. They may all have different strategies or different nuances or different time horizons or different sizes of capital. So, that makes them more restricted in some ways, less restricted in others. They're also different size of firms. So the bigger the firm, there's often more bureaucracy in how quickly you can act on information, because you've got more money to move. And so it takes time. And the essence of what I'm getting across here is that this creates lag. It's not like new information comes out, all of the players act at the exact same time in the exact same way and move their money in the exact same way. It doesn't work like that. It often takes weeks to months, or sometimes even longer, depending on what the information is and what the theme is, for capital to flow into an asset and out of another asset. Because money doesn't just come from nowhere. It flows out of something to go into something else, and to go into something else, it flows out of that and into that. Why is this important? This lag creates drift. So drift is the reason, pretty much, that momentum strategies can work. It's the idea that momentum persists. If you have a clear reason for momentum, the idea of the trend continuing comes from this. This is the core idea behind fundamental analysis. It's also the reason why, if you're just a technical only trader, if you're doing things correctly in the right market environment, that can work as well. Fundamentals, you do have advantages, but I'll talk about that as we go on. And so why am I telling you all this? Why does it relate to what we're doing? Well, because when we are understanding, okay, where can I get the best return on my time in terms of fundamental analysis without becoming this like mathematical genius who's incredible at building all these models and yada, 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 it makes us look at the system that we have. So let me just go down here. So the first thing to understand is that the financial markets are a regulated industry. They're regulated for fairness. This is a good thing. But it also means that a lot of what larger firms are doing, they have to be public about. They can't just keep it private. There's many reasons for this. I don't really want to go into every single reason because it's not really that relevant to this video. But let's just take an example and it will make sense with the example, hopefully. Let's take stocks as an example. I'm trading a lot of stocks these days, more so than FX, just because there's more opportunity in stocks. So these are some, not all, some types of fundamental analysis activities that you've probably heard about or you imagine when it comes down to stocks. So things like complex financial breakdowns, going through financial statements, talking to business owners, talking to customers, surveys, analyzing supply chains, all of that stuff. But what happens with that information? Where does it go? Like, what do they do with it? Well, they put it into their estimates, because remember, fundamental analysts, their job is to predict. That's the whole name of the game. And because we're in a regulated industry, they have to share those things with the public. Now, it's not, it's a bit more nuanced than that, as I said, but the only part that you should care about is the fact that they have to share it. And because of this, at least in the case of the stock market, we get estimates. Now, within estimates, we can calculate some things such as the momentum of estimates. Are those estimates aggressively going up? Are they aggressively going down? They're only going to be doing that if they have done all of their homework. And these people are not stupid. They've done all their homework and they've assessed, oh God, this is changing. And they're making a decision based off that. This is a similar idea to if you're a technical only trader, you'll often hear technical only people saying stuff like, all available information is already filtered into the price. So I'm just looking and analyzing price because it's the reflection of all of the fundamentals. Technical analysts will say that a lot. And there's some merit to that. I don't think it's like a perfect argument, but there's definitely some merit to it. And it's a similar principle here. It's like everything, all the information that you associate with being complicated, often if you just go a layer above and look at who else or what group of people who are already very talented, because guys, jobs at hedge funds, quant shops, all these sorts of stuff, like these people aren't stupid. They've gone to, you know, through very intense academic processes. They've had experience. They've had great teachers, all of the things that most retail traders don't have. And so these people are, the fact that we have access to what they're doing is so valuable. And so going always that layer above of like, okay, this is what I'm trying to figure out. Do I become an expert at this, or do I just go one layer above? For example, if you were looking at starting a business, okay, and you were like, oh, okay, I don't know how to manage my finances. Does it make more sense for you to go to university, become an accountant, get 3 years experience and master accounting, and then come back to your business and be like, ah, perfect, cool, now I can do it? Or does it make more sense to just pay someone who's already done that, in other words, an accountant, and have them do it? Well, obviously, just pay the accountant. Obviously, it's a better use of time. Same thing here, except the beauty is a lot of the times you don't always need to pay for this sort of information. Sometimes you do, in full transparency, but a lot of the times you don't. Anyway, so then within here, you can have the momentum of estimates, the time horizon of estimates. So for example, are they predicting earnings for a company to go up next quarter, next year, whatever? And then the aggregation. So normally there'll be a set amount of analysts covering a particular stock at any one time. And so just looking at all of them and looking for trends in what the analysts are doing is going to also be a good indicator. There's a lot more than this, but these are just some. And then finally, we want to add a layer of review. This is basically just reviewing and trying to figure out why they believe that, whether you agree or disagree. It's not so much, you do need to have like a little bit of understanding about how the overall mechanics go in order to analyze this properly, but it's a lot more doable than what these guys are doing, right? Like infinitely more doable. I'll make a whole other video on that, but this is just like a bird's eye of the process. And so this is awesome. And the whole benefit of this, guys, is because, as I said, we want to get the most return for the least amount of work. But it's about, as much as possible, getting in this early stage, right? We want to have everything on our side, but this basically just tells us, look, does the move that's currently happening, does it have weight? Is it likely to fall apart? The reason I say that fundamental edges can have better edges on average than technical strategies is because with a technical strategy, you don't know, you can't even estimate where you are in the cycle. You can only base it off price. You could have the most aggressive price move in the world that looks like it's based on something so sustainable. You're like, oh, perfect, I'm going to buy this pullback, and then things crash down at the same speed. That can still happen with fundamentals, but overall, it's less likely if done properly because you know what you're getting into, you've done your analysis properly. Now, of course, this can get more complicated and get less complicated. If you did nothing else, the most important thing to master now would be understanding the risk management structure. Okay, this is a professional will analyze it in a much better way than, oh, I just use a stop loss and a positive risk reward. There's nothing inherently wrong with that. It's just not as sophisticated as it can be. And so that can lead to a more volatile equity curve a lot of the time. And so I'll leave right now the links to my previous video where you can check that out, where I describe that in detail so that you can hopefully get an insight into that. But I hope that you've enjoyed. The main essence of what I'm talking about here is if you always take the information you're trying to figure out, find out who is already smart at doing that, and then get access to those people and use that instead of becoming the master of the underlying skill beneath it. And now there's also more layers to this as well, because depending on what you're doing, if you're doing a top-down approach, you'd need to basically apply variations of this to the macro. At least with stocks, it would be the sector level, and then we have the stock level as well. And then there are other things as well. And then with each market, you have a similar sort of structure as well, and there'll be subcomponents. But again, depends how complicated you want to make it. If you want to make it super simple, that's fine as well. Some people love simplicity. Most people do, and that's fine. But anyway, hope you've enjoyed. Check out this video that will be up on the screen around now, and I hope you have a great day. Take care.